Hi there, I'm Irk, and this is my channel, Get Irk. In this episode, the exit strategy. When is it time to take profits? Longtime viewers of my channel are probably familiar with my approach to buying stocks, where I find levels of support and I buy in stages over time. In this episode, I wanted to talk about the reverse. When is it time to take profits? Now, investing and trading are always incredibly personal. It's all about your risk tolerance, your time horizon, what your goals are for the future, when you're going to need the money, and so much more. So as always, I am not a financial advisor, and even if I was, I'd need to look at your own personal status to be able to determine whether or not these strategies would work for you. But what I'm doing is showing you what my strategies are for when I take profits. The exit strategy, or when you're going to take profits on your position, is almost as important as when you're going to buy the position or how you research the position. However, the funny thing is, most investors and traders do not spend the time thinking about the exit strategy. So when an asset's value skyrockets, a lot of these investors don't know what to do. And if you watch Wall Street Bets, you'll see a lot of people turn a little bit of money into a lot of money and then back into a little bit of money because they didn't know when it was time to close the position. That being said, if you want to be a long-term investor who just buys and holds and waits until retirement or whatever your goal is to take profits, that's fine. Again, this is all personal. You do not have to be active unless you want to be. Just like I use technical analysis and look at the charts to find support levels where I can add to my positions, I do the same thing in reverse when it comes to taking profits. So we're going to start the video by doing that, and then I'll go over 3 different exit strategies that I have and the techniques I use to take profits on all of my positions, including when it's time to close a position entirely. So let's start with Block, ticker symbol SQ. Long-term viewers of my channel know I use this one as an example all the time, and that's because Block is extraordinarily volatile. As you can see, just since last August, Block has sold off more than 70% from its all-time high to its recent low. This is a stock that really moves over time. And because of this, Block is one of those positions that if you do hold shares, you might want to take profits over time since it is volatile and will go up and down regularly. So I've shown you in the past that you can use Fibonacci retracement to determine buying levels on the way down, but we're going to do the reverse. You can use Fibonacci retracement from the all-time high to the all-time low to find resistance levels on the way up. Whereas support is where buyers come in to buy the stock because of past price action. Resistance is where we have buyers in the past who have bought much higher, and now that their positions at break even, they either want to reduce the size of the allocation or close it entirely because they no longer have a loss. And here with the Fibonacci retracement, you can see that there are specific levels where there is resistance over time. In fact, right now, when you look at its recent price action, it did come up, break through this 23.6% retracement at $131.46, stopped here at $146.79 before pulling back, dropping below that retracement level. From there, you can see that our next retracement level is the 38.2% mark at $161.61, followed by $185.98, $210.34, $245.04, and its all-time high at $289.23. Just like Fibonacci retracement can develop levels on the low side when you're talking about support, it can do the same on the high side when you're talking about resistance. And you can see we have additional levels of potential resistance here at $345.40 and then $416.85. And this is despite the fact that its all-time high is only $289.23. So you can even have levels of resistance above where you might have price targets. When you're talking about levels of resistance where you want to take profits, it's the same concept in reverse as when you want to buy. You don't necessarily want to wait until the low of a wick when you're buying a stock because it might not hit there. It might find support above it. And the same is true when you're taking profits. Depending on how conservative you are when you want to take profits, you might want to use the base of a candle or the top of a candle and not the wick as your target for when you're going to take profits. For example, even though the all-time high of Block is $289.23, you can see in the past that there were several points where it didn't hit that all-time high. So if you waited for it to hit $289.23 again, it's possible that it will find resistance before that. So depending on how conservative you are, you might even want to use $270 or lower as a target for when you would take profits. As I like to say, I'm always wrong. I never sell at the all-time high and I never buy at the all-time bottom. Since I'm a long-term investor, my goal is to build a position and take profits over time and add to the position over time. If I waited to the all-time high or I waited for the all-time bottom, chances are I would miss the opportunity to buy at a really good price or to take profits at a really good price. So I tend to like to take profits below a level of resistance. Now that you've got the general idea of how to find resistance on a chart, let's take a look at 3 different exit strategies that I use for my own positions of when I decide to take profits. Exit strategy number 1 is to maintain a position's allocation size in the portfolio. Whether you're talking about stocks or cryptocurrency or any investment class, I always break my portfolios up by allocation size. What that basically means is I divide the portfolio into a certain amount of percentage that I allocate to each one of the positions. It's really quite easy to do this. If you wanted to make it so that every position in your portfolio was going to be of the same size, you would take 100% and divide it by the total number of positions in your portfolio. In other words, if you had a portfolio with 10 positions in it, 100% divided by 10 is 10%. That means each one of the positions in your portfolio would be at max 10% of the overall portfolio size, including the cash on hand. When we take a look at my chart of Block, you can see that I have my target for when I'm going to add the position down here at $83.50 in green, but I also have a target of when I'm going to sell my stock at $179.90. When you scroll back, you can see that this is beyond some of the past levels of resistance. So you might wonder, why is it that I'm targeting that high and I might not be able to get to that point for some time? For me, I already have all of my original capital out of my Block position in addition to 3 times the original capital. So not only did the shares not cost me anything, I pulled 3 times the original investment out of the stock. So I'm not as worried about taking profits. Since this is a long-term holding, I'm more interested in ensuring that Block does not outgrow the allocation size for my portfolio, making it too big a part of the overall portfolio. So I calculate a price target where I could sell some of the shares of the position and still maintain a full allocation size. In other words, Block will exceed the target allocation size for the portfolio by the time it reaches $180. But at that point, it will sell enough shares where it will go back down to the target allocation size. Your approach doesn't need to be all wonky and complicated like mine is. Some people just sell a little bit of their stock when it reaches a point where it's outgrown the allocation size. Some people wait until it grows to the allocation size and then reduce it so it's less than the allocation size. And once again, it's all personal. However you do it is up to you. We can look at Apple, ticker symbol AAPL, as another example. Apple is currently the biggest position in my investments in play portfolio, and you can see that I've got a target to sell the stock at $179.41 if it gets that high. Looking in the past, this is a little bit better than Block because you can see there's quite a bit of resistance up there. However, it also coincides with the fact that by that point, my position will have outgrown the target allocation size for the portfolio and I'll need to reduce it anyway. However, just like Block, I have taken all the original capital out of my Apple position. So if it doesn't make it up to that point and take profits and it just retreats, then that's fine. I've already taken all of the capital out, so I really have no real money at risk. A lot of traders and investors probably just bristled a bit when they heard me say that it's not real money. However, the thing is, I think Apple's going to be good for 20 years or longer as an investment. So I have no interest in reducing the position any more than I absolutely need to. I want Apple to help lift the overall portfolio size as it goes up. So I'm not anxious to take profits since there is no original capital left in the position. Strategy number 2, taking profits in a stock that's increased in value extremely fast. For this strategy, I'm going to use Dutch Bros, ticker symbol BROS, which just IPO'd last year. I initially opened my position in Bros on September 20th of 2021 at $42.25. Being that it was an IPO and didn't have a whole lot of price action, I only bought half of the allocation that I wanted overall in the stock. And as an example of a very high quality problem, Bros ended up taking off from there. I ended up taking some profits on October 19th at $62.50, and the reason for this is I had nearly a 48% gain in less than a month. However, in order to avoid FOMO, or the fear of missing out, I never sell my entire position. I only sold about 10% of the overall allocation because we still didn't know how high it would go, and you can see that Bros ended up going much higher from here. Bros ended up hitting an all-time high of $81.40, and that means I missed out on more than 30% of additional upside. But again, that's why I only take small amounts of profit instead of taking all of the position off, because I still had exposure to that. However, as we came to the end of 2021 and moved into 2022, you can see that taking profits ended up being not a bad decision at all, as bros ended up selling off with a lot of the other IPOs and high-risk assets. Bros ended up hitting a low here in January at $38.11, a drop of 39% from where I sold at $62.50. Additionally, because I buy in stages, I replaced the shares I sold on October 19th on December 3rd at $45, effectively locking in a 28% discount on the shares that I had sold. Another great example of why you might want to take profits in a position that grew too far too fast is Roblox, ticker symbol RBLX. You can see that I bought in stages over time, starting on September 29th of 2021 and proceeding to October 8th of 2021, at which point Roblox really took off. From that point to its all-time high, Roblox nearly doubled, going up more than 100% from that point to its all-time high. However, I didn't sell until November 30th. Now, the reason was I was going to wait until Roblox doubled from my average per share cost before I took any profits. But when it didn't reach that point, I decided that I would take profits should it make another attempt, which it did on November 30th at $136. And unlike the Dutch Bros example, this ended up being very much the right decision because Roblox really sold off. Roblox's 2022 low is down here at $36.04. That's roughly a nearly 75% drop from where I took profits. Now, sure, my position is still down because I did buy in stages on the way down to replace the shares that I had sold. But imagine missing out on nearly a double in gains and then having a position go down 73%. You never know where a position's gonna go. You only have 20/20 hindsight. So it's really easy in certain examples like Dutch Bros to say, hey, why didn't you wait to take profits? But when you have a case like Roblox, you can see there was no opportunity to sell at a higher price. In fact, it went much lower. Now let's look at a position that has a lot more price action. Tesla, ticker symbol TSLA. I originally started my position in Tesla in the pandemic sell-off, making two separate buys to get about a 50% allocation on its way down. And with my last buy on March 18th, Tesla broke through to a new all-time high, which was more than double my per share cost. So I took profits on June 11th at $197.36. And this is one of those ones that really stings because Tesla didn't just go up higher, it went up way higher from where it was. But like I said earlier, this is why I only sell some of my position and not all of it, because you never have any idea how far up a stock's gonna go. And in Tesla's case, that high is $1,243.49, an increase of nearly 1,700% from its lows just a year earlier. I don't mean to spoil investing for anyone, but let me explain something. They're not all going to be Tesla. Trust me on this. So yeah, I missed out on a huge amount of gains in Tesla, but I still kept the majority of the position. So now with no capital in my Tesla position and profits taken out of it, I can be very patient about when I take profits. And this is an incredibly volatile stock. A lot of people have very polarizing opinions on this, but I don't have to worry as much if Tesla sells off to $300 like some bearish analysts think it will, because I've already taken all the capital out. I'm playing with the house's money, and again, I'm planning to hold Tesla for 20 years. For me, a sell-off to $300 would be an excellent buying opportunity because I have belief that over time, Tesla's going to just keep increasing in value. Now, that might be 10 to 20 years, but still, I'd love to add to it at lower levels. In this particular case, since I've already taken all the capital and profits out of my Tesla position, I will never put capital back in. I will only put the profits back in. And even if Tesla sells off lower and I'm all in, that's it. It's one of the strategies I use to protect against the downside. I don't ever want to turn a winner into a loser. Exit strategy number 3 isn't really profit taking. It's more of when do you close a position, or when do you get your capital out of a position even if it hasn't grown to the allocation size. My first example is AT&T, ticker symbol T. If you've watched a lot of my videos, you already know the story behind this one. I bought AT&T not because it was a mobile provider, but because it owned Time Warner, which was a streaming service, and because it had a dividend. I did want exposure to the wireless sector, but AT&T wasn't the best in breed in space. The reason I got it was because it had that streaming kicker and a great dividend. Except on May 17th of 2021, the CEO announced that they would be spinning off the Time Warner asset and cutting the dividend, which completely defeated my thesis. So even though the stock popped initially on the news, I did close my position at $31.92 on the 17th. And you can see this ended up being a really good decision, as AT&T has sold off dramatically and has never recovered from there. I'm far from the only investor who thinks this company has poor management and that was a very poor decision to cut the dividend and sell Time Warner. AT&T has sold off more than 35% from where I closed the position, and because the thesis is now broken, I will not be re-entering AT&T at any point. For my next example, I wanted to show a position where I took all the capital out even though it hadn't increased to a target allocation size. Skyworks Solutions, ticker symbol SWKS. On December 16th of 2021, news broke that Apple, a huge customer of Skyworks Solutions, would be starting to develop its own chips that would compete with Skyworks. In fact, if Apple is successful, Skyworks would lose Apple as a client. Since Apple makes up such a huge part of Skyworks Solutions' overall client base, this was not good news. Now, although recently Apple has a really good track record of developing its own silicon, there's no promises that they'll be successful. It's a bit of a coin flip. If Apple isn't successful making its own chips, it will stay with Skyworks Solutions. However, if it is, Skyworks will lose them as a client. At that point, I had an 80% gain in Skyworks Solutions, and I still have faith in the products, the management, and the company. However, I do believe that if Apple is able to develop its own product for this particular line, it means that Skyworks Solutions' valuation will get damaged really, really bad. So I didn't want to risk any of the capital, especially since I already had an 80% gain. So in this particular case, rather than close the position altogether, since my thesis was altered but not broken, I just pulled the capital and some profits out on December 17th at $144.59. Usually I follow what's called the 3-day rule, which means you wait 3 days after a news event to see how a stock plays out. I broke the rule in this case, and you could see from the price action that I did make a mistake because Skyworks ended up heading higher from where I had sold off my capital. However, that move was short-lived, and Skyworks ended up selling off in a big way, just like the rest of the market into 2022, hitting a low down here at $118.99, a sell-off of nearly 20% from where I took my capital out earlier in December. When it comes to long-term investing and taking profits, there's a saying that airline pilots use: any landing that you can walk away from is a good one. When it comes to investing, when I look at taking profits, I think any gain is a good gain. Yes, there are situations like Tesla where a stock can go much, much higher after you've taken profits. However, there are also situations like Roblox where it can sell off dramatically after taking profits. It's always important that any long-term investment you buy is one that you have faith in over the long term. If your thesis breaks, absolutely close the position. However, you shouldn't be afraid of being down in position just because it's sold off. As long as your thesis is intact, you should stick with the position over the long term. However, taking profits is never a bad thing. I always say you can always buy back at a higher price, but you can't take profits unless you have them. In other words, when it comes to a stock like Roblox that went up to $136, if it ended up going up to $300, you could always add to the position up there. But if your per share cost was $80 and it sold off to $35, you don't have any profits to take. To learn more, check out my website, getirk.com, which is always 100% free. Please hit like and subscribe, and I'll see you in the next video.